Welcome to Tech Money Madness, your daily U.S. stock market podcast, April 14th, 2026.
Glad to be here. We have quite a day to cover.
We really do. I mean, imagine opening your brokerage app today and just seeing a sea of absolute green. We are talking, record-breaking tech rallies, billion-dollar acquisitions in space internet.
Right, the kind of momentum that makes you feel like the economy is just practically invincible.
Exactly. But then, you put your phone away, you drive down to the local gas station, and you realize people are now taking out 7-year auto loans just to afford the car they're filling up.
Yeah, it's a wild contrast.
It's completely divorced from reality. So, our single source for this deep dive today is the Daily Market Briefing. And our mission for you, the listener, is to basically decode this massive disconnect.
Because on one hand, you've got these major U.S. indexes rallying hard, and oil prices are actually tumbling today.
Right. But on the other hand, underneath all that green, investors are filled with this, palpable, quiet trepidation. So we need to figure out what's actually driving the money today. Okay, let's unpack this.
Yeah, to really understand how fractured things are right now, we have to kind of pull our eyes away from the trading floor and look directly at what's happening to the everyday consumer.
Right.
Because, if you just read the macro numbers without looking at the micro reality, you're missing the entire plot.
Well, the briefing lays out some inflation data that illustrates that perfectly, I think. So wholesale prices rose 0.5% in March.
Which, surface level, is actually less than expected.
Yeah, especially considering the ongoing war disrupting global supply chains right now.
Yeah.
So the market took that slight miss as a massive win.
It was a collective sigh of relief, really. I mean, a 0.5% increase is still inflation, right? Prices are still going up.
Right. Things are still getting more expensive.
Exactly. But the fact that it came in under the consensus expectation, it gives investors hope that the worst of the inflationary pressure at the wholesale level is finally cooling off.
But wait, how can they celebrate that when right next to it in the briefing, the Dow Jones consensus estimate is expecting the producer price index, the PPI, to jump 1.1% for March?
Yeah, it's a massive contradictory leap.
Let's define this for someone who isn't, staring at a Bloomberg terminal all day.
Yeah.
What is the actual mechanism here? Like, how does a 1.1% jump at the producer level actually hit the person buying groceries?
That's the critical question.
Yeah.
So the producer price index measures the average changes in prices that domestic producers receive for their output.
Okay.
Think of it as the factory gate. If it costs a manufacturer 1.1% more for raw materials, labor, and the electricity to just run their machines.
They don't just absorb that cost.
Exactly. They pass it down the pipeline. The wholesaler pays more, then the distributor pays more, and ultimately the retail store marks it up even higher to maintain their profit margins.
Wow, okay.
Yeah. So that momentary relief about wholesale prices cooling is essentially a mirage.
Because the pipeline pressure is still there?
Yeah, the pipeline pressure shown in the PPI guarantees that the consumer is going to feel a squeeze at the register, months from now.
Which brings us to how the consumer is actually handling these costs right now. And the briefing highlighted a specific detail that genuinely made me stop in my tracks today.
The auto loans.
Yes, the share of 7-year car loans is surging. Buyers are stretching out their auto financing to 84 months just to afford the monthly payments.
It's incredible.
And because they are spreading it out so far, the total amount financed has reached an all-time high.
Well, what's fascinating here is that it fundamentally changes the financial health of the American household. An auto loan is secured by a rapidly depreciating asset.
Right. The moment you drive it off the lot, it loses value.
Exactly. So when you stretch that timeline to 84 months, you virtually guarantee that the consumer will be underwater.
Meaning they owe more than the car is worth.
Right. They'll be underwater for years.
Let me stop you there and push back on the market narrative for a second, because this feels like a dangerous illusion to me.
How so?
Well, oil prices are tumbling right now. A consumer goes to the pump, they see cheaper gas, and they feel like, hey, the pressure is off.
Sure.
But if they just signed away 7 years of their life for a depreciating asset, an asset that will almost certainly need, like major repairs, maybe a new transmission or brake overhauls, in year 4 or 5, they are trapped.
Oh, absolutely. They still owe 3 years of payments on a broken car.
Right. So if the consumer has to bankrupt their future just to keep driving to work, isn't this entire market rally built on a foundation of sand? Like, Are investors really that blind? Or do they just assume the Fed is going to swoop in and bail everyone out before these loans default?
Well, the market isn't necessarily blind, but it operates as a discounting mechanism.
Hold on. People throw that phrase around all the time on financial TV.
Like,
What does a discounting mechanism actually mean in the context of my neighbor's 84-month car loan?
fair point. A discounting mechanism basically means the stock market isn't pricing in today's problems. It's pricing in what it believes the world will look like, say, 6 to 9 months from now.
Okay.
So investors see the tumbling oil prices today, and they see the explosive productivity promises of the tech sector, and they essentially gamble.
Gamble on what?
They gamble that these positive forces will generate enough wealth or trigger enough rate cuts to rescue the consumer before that long-term debt bomb explodes in suburban driveways.
Wow. So they are prioritizing the immediate liquidity over the eventual insolvency.
Yes, exactly.
That sounds like a terrifying game of chicken. And I guess it brings us to the people actually steering the economy who seem to be walking a very precarious tightrope right now.
Oh, without a doubt.
Let's look at the macroeconomic environment and the Federal Reserve. So Treasury Secretary Bessent came out today backing rate cuts.
Which would obviously lower borrowing costs for our consumer with that 7-year car loan.
Right, but he added a massive caveat. He said he is totally sympathetic if the Federal Reserve wants to wait, citing the current economic fragility.
Yeah, he's acknowledging the fire on both ends there.
Right.
I mean, Bessent knows the consumer desperately needs cheaper borrowing costs.
But he also knows the mechanics of inflation.
Exactly. If the Fed cuts rates too soon, they inject cheaper money into a fragile system where, as we just said, the producer price index is already jumping 1.1%.
Right, that extra money just chases the same limited goods.
And then you reignite the exact same inflationary fire you spent the last 3 years trying to extinguish.
And speaking of the Fed trying to navigate this, the briefing notes that Fed nominee Warsh just released his new financial disclosures.
Right. They came out today.
Yeah, and strictly looking at the filings released today, Warsh possesses a level of wealth that is historically unique for past Fed chairs.
Very true.
And from a purely analytical standpoint, I mean, we aren't taking sides here, but this means the composition of the Fed's leadership is navigating this consumer debt crisis from a vastly different socioeconomic vantage point than their predecessors.
It definitely introduces an interesting variable into how policy might be debated internally. Because, when you're modeling economic pain, your personal vantage point often influences which data points you weight most heavily.
Right. Do you prioritize saving the labor market, or do you prioritize protecting the purchasing power of the dollar?
Exactly. It's a huge balancing act.
Especially when the global environment is actively fighting against you. And that actually brings us to probably the most alarming note in today's geopolitical briefing.
The Citadel comments.
Yes. Citadel's Ken Griffin made a really stark statement today. He warned that a global recession is, and I quote, inevitable if the Strait of Hormuz remains shut due to the ongoing war.
Yeah, that's a heavy word to throw around.
Yeah.
Inevitable.
Right. I want to spend a second on why he's using a word that heavy. For the listener trying to picture this, what are the actual mechanics of a Hormuz closure?
Well, the Strait of Hormuz isn't just a shipping lane. It is the single most critical choke point for global energy.
Period. Yeah.
Roughly 20% of the world's liquid fuels passes through that narrow stretch of water. We are talking about millions of barrels of oil and massive quantities of liquefied natural gas every single day.
Wow.
So if you shut that door, you don't just raise the price of gasoline in California. You freeze the chemical manufacturing plants in Germany.
Because they don't have the power.
Exactly. You halt the factories in Asia that rely on imported LNG for electricity. The supply shock is so sudden and so pervasive that it instantly crushes global manufacturing and consumer spending simultaneously.
So it's essentially an economic heart attack.
That's a good way to put it, yeah.
But here's what I don't get. If a global recession is genuinely inevitable with that door closed and, the war is actively threatening it right now, why on earth did the major indexes rally today?
It's the disconnect again.
Right. Are investors just ignoring reality? How can you have green on the screen when a massive artery of the global economy is in jeopardy?
If we connect this to the bigger picture, it's about how capital manages unquantifiable fear.
Yeah.
Investors are basically compartmentalizing risk.
Okay, unpack that.
Well, you can build a financial model for a 1.1% PPI increase, right? You can model default rates on 7-year auto loans. But trying to model the exact geopolitical timeline of a blockade in the Middle East, it's impossible.
Because it's human behavior in war.
Exactly. So since institutional capital cannot accurately price in the exact day a war will escalate or resolve, It essentially puts a pause on the worst-case scenario.
So they just pretend it isn't happening.
More like capital abandons the physical world, which is, fraught with danger and heavy regulation, and flows heavily toward what it can understand, control, and model.
And right now, what it can model is the explosive, almost gravity-defying growth in the tech sector,
Exactly.
which is the perfect transition. Because while the physical world is facing blockades and systemic shortages, the digital world is essentially printing money. Let's look at the market movers today.
The contrast here is the real story today.
The divergence between the physical economy and the tech oasis has never been wider. The most active stocks today are the usual heavyweights, right? Apple, Microsoft, and Amazon.
Unsurprising.
Yeah. And the top gainers are Nvidia, Amazon, and Oracle. And just to give the full picture, Zscaler and Cloudflare actually took hits as the day's top losers. But let's zero in on the winners.
Let's do it.
Nvidia is currently on a massive 10-day winning streak, up 18%. And the sentiment is so feverish right now that they had to publicly deny rumors they are in talks to buy a large PC company.
Right.
Why do those rumors even start in the first place?
Because the market is desperate to justify NVIDIA's valuation multiples. I mean, when a company is up 18% in 10 days on top of already historic highs, investors start looking for the next structural leap.
Like, what's the next big conquest?
Yeah, exactly. If they aren't just selling chips, what if they buy the hardware companies that actually house the chips? Denying the rumor just highlights how desperate the market is to predict their next move.
And then we have Amazon taking conquest quite literally into space.
Yeah, this is huge.
They aren't just optimizing warehouses anymore. They are shelling out $11.6 billion to buy Globalstar. And this is to bolster their low Earth orbit, or LEO, satellite business.
The mechanics of this acquisition are just fascinating because, look, we've spent decades relying on terrestrial fiber optic cables laid across the ocean floor.
Like the backbone of the internet.
Yeah, but those cables have physical limitations. They are vulnerable to geopolitical sabotage, and they have latency limits because the data has to travel through glass, across deep ocean trenches, and, navigate international borders.
So Amazon is just circumventing the Earth altogether.
Precisely. Data travels faster through the vacuum of space than it does through glass.
That's wild to think about.
Right. So by building a low Earth orbit constellation, Amazon isn't just offering internet to remote areas. They are trying to own the ultimate frictionless infrastructure for global cloud computing.
So they want total control.
Yeah, they're spending $11.6 billion to ensure their AI data centers can talk to each other globally without ever touching a piece of infrastructure they don't own themselves.
Okay, that word infrastructure is the key to everything happening today because it explains the wildest jump on the board.
The energy plays.
Yes. Oracle jumped for a second day, but Bloom Energy absolutely skyrocketed, up 22% purely off an AI data center power deal.
Incredible move today.
Now, people keep using this old cliche that these companies are, selling shovels during a gold rush, but I hate that analogy. It feels too small for what's happening.
Oh, yeah. How would you frame it?
Here's where it gets really interesting to me. This Bloom Energy spike is like the tech sector building a fleet of massive, state-of-the-art supersonic jets, only to suddenly realize they completely forgot to build the runways.
Okay, I like that.
The AI software is the jet. It is brilliant and it's fast. But these data centers require immense, unfathomable amounts of physical electricity to run and cool the chips. You literally cannot launch the jet without the concrete.
Right.
Bloom Energy makes the fuel cells and the physical power infrastructure. They are building the runway.
That is a much more accurate mechanical analogy, I think.
Yeah.
And it really explains why the capital is flowing there. The tech sector growth theme is mutating.
Mutating how?
Well, it's no longer contained to consumer apps or software as a service. Tech has realized that to achieve digital dominance, they have to vertically integrate into hard physical infrastructure.
Because they can't just rely on the old grid.
Exactly. They need their own power grid, which is Bloom Energy. They need their own global communication lines, which is Globalstar.
They are essentially building a parallel physical economy because the traditional one is just too fragile.
Yeah.
We even saw this with Lucid today. The EV maker expanded its deal with Uber and named an auto industry outsider as their new CEO.
Right. Bringing in a tech perspective.
Yeah, it's another attempt to treat a heavy physical manufacturing problem like a nimble software platform.
It really is the tech mindset trying to overwrite the laws of physical manufacturing.
But this attempt to overwrite the physical world brings us to our final and honestly most mind-bending theme of the day. Virtual booms versus physical shortages.
Oh, this is the best part of the briefing.
The briefing highlights two emerging trends that perfectly capture the absolute absurdity of the April 2026 economy.
The juxtaposition here is difficult to wrap your head around, honestly.
Tell me about it. So on the virtual side, the crypto exchange Kraken has confidentially filed for an IPO, but even wilder, prediction markets are exploding.
Oh, the volume is insane.
The briefing estimates they will reach $240 billion in volume this year, and they project them to hit a staggering $1 trillion by 2030.
And for anyone unfamiliar, prediction markets are platforms where you can trade contracts based on the outcomes of future events.
Right, like betting on the news.
Exactly. Will a specific candidate win an election? Will the inflation print hit a certain number? Will the Strait of Hormuz reopen by Tuesday? It is the total financialization of probability.
But I have to challenge this. Isn't this just a massive glorified casino? Like, how does pouring hundreds of billions of dollars into a digital betting market actually solve anything or create real value?
Well, the argument for them is the wisdom of the crowds.
Which means what, exactly?
It's the idea that a million people putting their own money on the line creates a more accurate forecast than a dozen experts in a closed room.
Okay, I guess I see the logic.
But your point about value creation is the crucial one here, especially when you look at the second trend in the briefing.
Right, because in stark contrast to this infinite digital growth, Europe is currently facing a systemic jet fuel shortage.
Yeah, a physical crisis.
It is brewing right now, and it could severely hit commercial flights. We aren't talking about a labor strike or a software glitch. We are talking about a systemic shortage of the actual physical liquid needed to keep airplanes from falling out of the sky.
And this is the friction of the physical world I mentioned earlier. This raises an important question. To fix a systemic jet fuel shortage, you have to navigate international supply chains.
Right.
You have to deal with environmental permitting that can take a decade.
Yeah.
Massive physical refinery construction. Geopolitical warfare.
So capital just avoids it entirely. I mean, why spend 10 years fighting for a refinery permit when you can spin up a prediction market smart contract in 10 minutes?
That is the tragic mechanism at play here. Capital flows along the path of least resistance. Digital scaling is frictionless. You just need more servers and better code.
And the physical world is the opposite.
Right now, the physical world is incredibly resistant, heavily regulated, and fraught with danger. So, global capital is essentially giving up on fixing the physical supply chains and instead building a trillion-dollar virtual casino to bet on when those supply chains will fail.
Oh, wow. You could theoretically be sitting in an airport in Europe, staring at a grounded plane because of a systemic jet fuel shortage, and pull out your phone to place a bet on a prediction market about when the flight will actually take off.
It perfectly encapsulates the era. We have built an incredibly sophisticated mechanism for speculating on our own decline while completely starving the infrastructure needed to prevent it.
Wow. That really puts this entire bizarre day into crystal clear perspective. So bringing this all together from today's daily market briefing, we have navigated three massive themes for you.
Yep.
First, profound economic uncertainty. We have geopolitical war threatening the Strait of Hormuz, warnings of an inevitable global recession, all while the everyday consumer is quietly drowning in 84-month car loans just to get to work.
Second, we have incredible tech sector growth, but with a new physical twist.
The runway.
Exactly. AI and cloud dominance are forcing tech giants to build their own infrastructure, driving billion-dollar acquisitions in space with Amazon, and reshaping the power grid with companies like Bloom Energy.
And third, the overarching theme of market volatility. We are watching a market rally built entirely on the expectation that tech productivity will somehow outrun consumer debt and geopolitical collapse.
Which means the ultimate takeaway for you, the listener, is cautious skepticism. The green on your screen today is real money, but it is driven by compartmentalizing incredible risk.
You can't just ignore the real world.
Exactly. You cannot let the frictionless gains of the tech oasis blind you to the heavy physical realities of the macroeconomic desert. The underlying consumer data is fragile, and eventually, the physical world always collects its debts.
And as we wrap up, I want to leave you with a final provocative thought to chew on. We talked about how the modern economy has mastered the movement of data, but has entirely forgotten how to move atoms.
$1 trillion casino.
Right. We are scaling prediction markets to $250 billion this year, gathering the collective bets of millions of people. If that volume keeps growing and the financialization of probability becomes that massive, wait, I shouldn't say it like that. If it becomes that huge, could those betting markets eventually become a better, more accurate predictor of when the Strait of Hormuz will reopen? or when the next inflation crisis will hit than traditional economic experts or even the Federal Reserve.
That's a fascinating question.
When $1 trillion of crowdsourced money is on the line, maybe the casino knows something the models don't. Think about that the next time you see a market rally that defies all physical logic. Keep questioning the headlines, keep looking for the physical realities behind the digital numbers. That's all for today's episode of Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage.